Welcome to the first episode of the Seatrade Maritime Podcast for 2025. Hi, this is Marcus Hand, editor of Seatrade Maritime News, and it's become a bit of a tradition on the podcast that we start the year with a markets outlook discussion with the experts from Maritime Strategies International, and take a look at what we can expect in the major shipping sectors in 2025. You'll be hearing from Adam Kent, Daniel Richards, Will Fray, and Tim Smith from MSI. We'll be discussing the outlook in 2025 for container shipping, dry bulk shipping, tankers, and shipbuilding. Before we drill down into these specific sectors, we'll be starting with a broad macroeconomic outlook from Adam Kent. Welcome back to the podcast, Adam. And if you could set the scene for our listeners as we head into 2025, what are the big themes ahead?
Hi, Marcus, and thank you for having us back. Before we look at 2025, it's probably worth just casting our eye back over 2024. And as a whole, it was another positive year for the shipping markets, with many shipping sectors continuing to do well on average. Cargo growth was positive pretty much across the board, and ton-mile impacts, especially due to the Red Sea, continue to support earnings across the board. For some sectors, we actually saw earnings or values or both increase by over 50% over the course of last year, most notably for the containers and for offshore. And it really was just LNG where we saw earnings and values fall off year on year. At the back end of 2024, we did start seeing softening, however, on dry bulk and tankers, and that may be a theme that we will explore further within this podcast. As we look through into 2025, we do expect the global economy to be relatively steady, sort of a similar level to 2024. Global GDP growth of around 2.7%. Though we would say that the risks, I guess, are increasingly looking on the downside. Of course, in the US, we're going to be faced with another second Trump administration coming to power in January. That does have the potential to introduce some macroeconomic shifts, and some of them might come quite rapidly, given what we saw during the first Trump administration. Tariffs, of course, have already been mentioned a number of times, and these will have an impact on trade if they come to fruition. Though the levels mentioned so far, we don't think will be too disastrous for Chinese export volumes to the US, though again, that situation could change quite rapidly. We have, of course, been in this Trump environment and tariff environment before. Workarounds were found by the supply chains, and we do expect to see some of those workarounds come to the fore once more as we move through into 2025 and into 2026. Chinese economy still remains sort of in the doldrums, but we are seeing some signs of improvements, and further policy easing and stimulus will sort of undoubtedly help the economy in 2025. Whereas on the flip side, the European economy is probably best described as fragile as we come into 2025. More broadly, from a shipping perspective, we do think that this year will be another year when we see cargo growth firing on all cylinders, with positive growth across the board, across all sectors. Little to suggest currently that the Red Sea situation is likely to find a resolution anytime soon. And we now think that this will continue across 2025, and we'll see the same level of diversions around the Cape of Good Hope as we saw in 2024. That will, of course, remain positive from a ton-mile perspective, but we don't expect to see any net incremental gains from that diversion. Everything that will go around the Cape of Good Hope is going to go around the Cape of Good Hope, and that's already baked in. We did see another barrage of orders in 2024 at the shipyards. And this year, 2025, we do expect to see deliveries starting to creep up. That will start putting some pressure on supply-demand balances. And that's probably a theme that we will expect to see continue, not only this year in 2025, but also in 2026, 27 and 2028. So this is sort of the start of a wave of new deliveries that sort of began in partway through 2024. We're now firmly sort of riding that wave for the next 3 years. So hopefully that sort of gives a sort of nice broad overview of where the markets have been last year and where we're sitting as we're at the dawn of 2025, looking across the next 12 months.
Thanks, Adam. I think that gives a very good overview of what kind of the big factors we're looking at of the year to come, and a number of topics that we can then drill down on more as we look at the individual sectors during this episode. If you're enjoying the Seatrade Maritime Podcast, make sure you never miss an episode by subscribing on the app of your choice. First, we shall be turning our attention to the container shipping market with Daniel Richards. Welcome back to the podcast, Daniel.
Hi, Marcus, and thanks for having us back on.
Great to have you back. Now, Daniel, the container shipping market in 2024, I think it's fair to say, was very different from what we expected. Are things now sort of starting to settle and normalise as we move into 2025?
Yes, it's certainly been a surprising year and far different from what we all expected 12 months ago. There is a sense that things are beginning to calm down. I think the volatility, some of the uncertainty we saw at the start of the year, that's now reducing in scale. Markets have cooled off from generally where they were in the summer, at least for freight markets, but they do still remain a lot higher than they were 12 months ago, which I think was many people's idea of what a more normal market would look like. If you're looking at spot freight rates from the Far East and Northern Europe, so vessels that are now almost all now going around the Cape of Good Hope, those are still in the 4,500 to 5,000 per 40-foot box range, compared to a pre-Houthi attack level, which has settled closer to sort of $1,500 to $2,000. So it does remain a much more profitable environment for liner operators than was the case 12 months ago. And there are major sources of risk and uncertainty as we move into the start of next year. There's no real sign of the Houthi attacks ending or liner companies being confident that they'll be able to go back through the Suez Canal anytime soon. You have the likelihood, not the certainty, but the likelihood of a renewed port strike in US East Coast ports and Gulf Coast ports in mid-January. And then there's the Trump factor. So it definitely feels that the initial impact of the Cape Good Hope diversions has been absorbed, and those are unlikely to provide further boost to markets. But there are definitely new forms of disruption on the horizon, and it isn't a market that's yet fully back to normal.
The Cape of Good Hope diversions, now those have effectively soaked up all that new capacity in 2024. Is it going to be enough to sort of soak up that wave of capacity that's coming in 2025?
It will certainly help, and without the diversions, the industry would clearly be in a very different situation today. Fleet growth will slow next year, and it will slow further again in 2026. It will still be an elevated pace of growth. We think that fleet growth, after being around 10.5% year over year in 2024, will slow to 5-6% next year, and that tapering down further to around 3% the year after. That's still a lot of tonnage to absorb, a lot of big ships to absorb in particular. We don't think it's going to be enough to maintain markets at this level indefinitely. What happens with trade growth? What happens with importers potentially rushing goods in to get ahead of tariffs? What happens with blank sailings and the new alliances? Those will have impacts on markets. So I think as long as the sailings continue, that's potentially putting a floor under markets that's higher than the situation was 12 months ago. But I think the diversions are unlikely to provide an incremental boost to markets as we move into next year. So without the diversions, the market would be looking quite a lot different. With them remaining in place, it's going to be a stronger market than you would otherwise expect, but their continuation won't be enough on its own, we think, to prevent markets falling further from where they sit today.
Right. But it provides that floor that you mentioned there. And it's MSI's view that the diversions are most likely going to continue through 2025 because the Houthi attacks are not going to stop.
Yes, our base case view across the board now is that 2025 will be effectively the same as 2024, differentiated by how far each individual shipping sector is already avoiding the Red Sea. So really that's a 2026 normalization scenario now for us. That's uncertain. We don't know what will happen when Trump takes office, if he prioritizes the Middle East, if there'll be a flurry of diplomacy there. But for the moment, it seems safest to assume that the current status quo is going to last for some time.
Okay. Yeah, fair enough. There doesn't seem to be any particular push factor to change the environment. And I think you mentioned there's quite a few things happening as we start 2025. You've got Trump becoming president and his tariff plans, possible strike on the US East Coast. And yeah, there's changes in alliances as well, which would potentially coincide with that US East Coast force strike. So how does all of that play out?
I think for the moment, this combination of factors is supporting the market. We've seen spot freight rates on a number of routes tick back up as we've moved into the start of Q4. And that trend is probably likely to continue through to the new year and pre-Chinese Lunar New Year cargo rush. What we have seen is that volumes moving into the US have been notably strong for quite some time now. So whereas, Europe seemed to have a relatively early peak season this year, the US has had both an early and an extended peak season. So volumes moving into the US have remained quite a bit higher year over year, all the way through October and the start of November. Clearly, some of that's related to getting goods ahead of the potential labour action. On the margins now, there may be some moves to get goods in ahead of potential tariffs. So volumes for the time being do remain relatively healthy. We think that on a trade basis, the level of trade growth we've seen this year, which is likely to be around 6% year over year in total in 2024, that's unlikely to be maintained next year or in 2025. But overall, trade growth should remain relatively healthy. So I think these disruptions for the moment are going to keep freight rates relatively elevated. The charter market, which is a source of costs for liner companies, of revenues for independent ship owners, that remains phenomenally robust, and that also seems very much set to continue, at least over the first half of next year. With the new alliances, there's going to be teething issues likely. There's the potential this could lead to some softening of freight rates if the new alliances are keen to retain customers, if there's concerns about retaining market share. As these new alliances are launched, they're a bit more differentiated in terms of the structure and the service offerings they're providing with customers. That's probably a level of differentiation that hasn't been seen for quite some time. So I think for the moment, these different sources of disruption, that they're more likely to lead importers to bring goods in early. That's likely to prop up trade volumes as we move into the first half of 2025. There will still clearly be an elevated pace of fleet growth. There's unlikely to be much scrapping next year. So it feels like current market levels are going to set the tone for what happens in the first half of 2025. But there are clearly notable new sources of risk and vulnerability to the market that are emerging.
Okay, so a strong start to the year, and then the latter half will depend on how certain other things play out by the sounds of it.
Yes, definitely. And we don't know, for instance, what Trump will actually do with tariffs. This is a huge level of uncertainty. What he said he might do on the campaign trail is not what he's initially promised to do via social media, with 25% tariffs on Canadian and Mexican goods, not particularly relevant for container shipping, and an additional 10% uplift to existing tariffs on US imports from China. The initial tariffs he introduced in his first term have pretty much all remained in place throughout the Biden administration. And I think that 10% uplift is maybe less consequential than it could be. It certainly means that there'll be a real gulf between the average tariff on Chinese goods versus tariffs moving in from places in Southeast Asia, from South Asia, but the 10% uplift in itself shouldn't have an enormous impact on trade, but it is likely to steal some trade from 2026 and bring that forward in 2025, assuming, of course, Trump goes ahead with this. He may change his mind. He might be using these threatened tariffs as a way to extract concessions from trading partners, and it's very unclear over what time frame the tariffs would be introduced. He's threatened and potentially could do this via executive action on day one or near enough, but that's an untested route. And in his first term, he took the more by the book approach, which saw tariffs actually being implemented around 18 months into his term. It's very uncertain. We think that the tariffs or the threat of tariffs is going to boost trade growth in 2025 above what you might otherwise see. But beyond that, the specifics become a lot more difficult to predict.
Yeah, indeed. I think tariffs will be something we'll be returning to when we talk to about some of the other sectors as we go ahead in this podcast. Thank you, Daniel. A lot of factors in playing there for container shipping as we move through 2025. I'd like to move on to look at the dry bulk market with views from Will Fray. Will, welcome back to the podcast.
Thank you, Marcus. Nice to speak to you again.
Likewise, and thank you so much for taking the time to talk to our listeners. Now, looking at dry bulk shipping market, Q4 of 2024 was not particularly good. Sort of what happened there, and where are we headed as we now move into 2025?
Well, I think it's probably helpful to look a bit further back in 2024 to make it clear that actually, I guess in a similar way to the container market, actually it was a very positive year, unexpectedly so, really. There are two major factors supporting the market, one of which was China's stockpiling, a lot of iron ore and coal. And the second factor, which we touched on several times, is also these inefficiencies. And we've talked about the Suez Canal, but also the Panama Canal at the start of the year had very low throughput. So these factors really helped the dry bulk market during a period where actually the underlying sort of economic fundamentals of trade, and in particular for China, which is the key support for dry bulk, were really quite weak. And China is clearly still struggling with some very under performance of the construction sector, particularly related to residential construction. And that's something that continues at the moment. I think it's worthwhile putting the sort of stockpiling into perspective. So there was growth of 165 million tonnes of cargo in 2024, estimated by MSI, whereas China's stocks of coal increased by 100 million tonnes and iron ore by 30 million tonnes. So these sort of significant imports then by China are partly used to build up those stockpiles in the face of very sort of weak underlying consumption. So I think the point is that when we're then heading towards the end of the year in 2024, what's changing? And I think one factor is really we shouldn't lose sight of the fact that there was 33 million deadweight of new ships delivered. So what we're starting to see then is actually the supply growth starting to now absorb all of that incremental demand from really those two major sources. Now, sort of looking through to 2025, then is this kind of supply growth then going to start to impact the market through 2025? This is where we are getting slightly more cautious. I think overall there is little to suggest that there's going to be much of a recovery in the underlying fundamentals in China, although potentially stimulus measures may have some impact, which we can talk about shortly. But as with containers, if there's no kind of significant incremental change again in additional inefficiencies, then the market's going to really quite struggle to absorb this 36 million deadweight of new ships that are scheduled to be delivered in 2025. Through our modelling, we can actually put a sort of number on that, and we estimate that the sort of tons of cargo that would be required to absorb that amount of new ships And that points to 240 million tonnes of incremental cargo required in 2025 to absorb these new ships being delivered. And I think that's really a tall order for the dry bulk sector.
Yeah, that is a very interesting number, that 240 million tonnes. It's a sort of major amount of additional cargo that has to be found. There's been quite a lot of talk about Chinese stimulus and so forth and new measures on that front. Would that help to sort of fill that gap that you just talked about there?
Yeah, it's a really, obviously, it's a point that's been talked through all through 2024 as well, with this underlying weakness in the Chinese steel markets, in the construction markets. Is where is this stimulus? What's happening, and at what point will it start to make a difference to the market? And I think, in general, those stimulus measures that the government took through 2024 hadn't really changed the underlying consumption of raw dry bulk materials. So the thing with China is obviously there's always massive potential for big change, and there is something they could do in 2025 to help support the underlying steel consumption. And I think we'd all agree that it will improve at some time, and stimulus measures will be part of that picture. The issue that MSI likes to raise is that the Chinese sort of the structure of their trade is changing, the structure of their economic growth is changing, and it's much more targeted in supporting growth in steel-intensive infrastructure, for instance. So as the urbanization rate starts to increase towards a sort of global developed economy level around about 70 to 80%, then we're expecting the government not to put in kind of widespread stimulus that can have a kind of very broad brushed effect on steel intensive growth. Is to be much more targeted, and therefore to have a much smaller effect in the future. It's going to be targeted towards different elements of the economy rather than steel intensive construction growth.
So it's not going to potentially have that kind of impact that we've seen in the past with these kind of stimulus measures. And I think I can't sort of not ask about the whole sort of Trump factor, tariffs, and the general sort of continued global geopolitical instability. How is that likely to impact the dry bulk shipping market in 2025?
Yes, certainly tariffs have had an impact in the past, and as Adam mentioned, that's something we've got some precedent to talk through. The issue is not necessarily with US imports, so the US is not a big driver of dry bulk imports. It's really about the potential retaliatory tariffs by its trading partners. In the past, the route most significantly impacted was soybeans trade into China, as China pulled back from importing soybeans from the US in response to those tariffs. Now, the issue is that when that happened last time, back in 2018, China had this widespread African swine fever. And so their demand for soybeans was low, and that helped to kind of offset this trade. So we saw far fewer imports by China, and we saw some trade diverted from the US into Brazil, and then Brazilian exports into China. So there are some kind of secondary factors, but the fact is that this time round, we don't think China will take such dramatic measures against US soybeans exports into China because they don't really have the same conditions they had before. So the demand will be strong enough that they will probably continue to import soybeans from the US this time round. That's not to say that there might not be some short-term impact where ahead of any tariffs that Trump might be implementing, then trade does have some short-term boost. But overall, I think dry bulk market this time around is probably going to be more isolated from these effects.
Okay, so it's not really that bigger impact based on what you're saying there, or you're not expecting that bigger impact from that. I think just one last question. In terms of you could say there's quite a significant amount of new tonnage coming in. Do you expect owners to continue ordering new ships, or is that going to really put them off the current market conditions?
Yeah, it's a really interesting question. That orders have certainly been quite strong in 24 and were supported by, I guess, a smaller number of larger owners ordering larger amounts of tonnage, if that makes sense. if next year we're right in that the market's going to soften, freight rates soften, and we're going to talk through shipbuilding shortly, but we still think there's going to be some support for new building prices, then it does get quite difficult to justify ordering more tonnage in 2025. So that is likely to soften, we believe, in the dry bulk market. I think it's a comment that people have made that the dry bulk market is a good place to invest because the order book is so small, and it's around just below 10% of the fleet. And historically, that's been the case, that around about 10% seems a low size of order book. But if we expect trade growth and demand growth to slow, then actually it doesn't seem to be too small in a world where demand growth starts to fall or starts to go from what has been 10% down to 5% now, 2% growth. Then the order book does need to shift lower in response. I mean, overall, it certainly is relatively positive to the market to have an order book of that size. It's not a big threat, shall I put it that way? But it's also quite front-loaded. So, as I mentioned, it's going to have an effect on the market. 2025 is going to have an effect on the market. And in longer-term future, then if there is low ordering in 2025, then perhaps it sets the foundations for some market recovery or prevents a long-term collapse in the dry bulk market. But it's still, I would say, I would no longer call it a low order book. I'd say it's probably something that is more in line with what the demand outlook should require.
Okay, that's very interesting, and I think that whole demand and supply equation is very, very important as you head forward, and it'll be interesting to see how this plays out during the rest of 2025. Thank you, Will. I'd now like to turn to Tim Smith and welcome him back to the podcast.
Hi, Marcus.
Hi, Tim. And I'd like to talk to you a bit about the tanker market. When we look at crude tankers, we've seen a weakening of rates at the back end of 2024, particularly for VLCCs. Is this set to continue into 2025?
Yeah, certainly Q4 went against expectations. Often we see conditions improve in that period for the tanker sector. And as you mentioned, we saw a definite deterioration in the market. That was apparent for the VLCCs. It was apparent in other sectors as well. And also product tankers saw significant drops in Q4. Yeah, conditions, I think, for the tanker market are similar in some respects to what we've heard for dry bulk and in other sectors as well, where we see some shift in terms of the supply outlook, the fleet outlook. 2024 saw what will likely be, when all the numbers come in, the second highest year of contracting for the sector, around 60 million deadweight ordered. And we also saw some structural changes in the market, in particular, again, reflecting some of the comments we've heard about the dry sector and looking at how China's evolving. And in China, in 2023, we saw an exceptional period of oil demand growth as a result of the slightly later release of COVID restrictions. 24, actually, we saw a real flattening off in terms of Chinese oil demand. And that's coming about partly because there are factors impacting, such as vehicle electrification. We're seeing very strong sales of electric vehicles in China, and also increasing use of gas in the trucking fleet as well. So these are factors that are going to be impacting the market for some time. As in other sectors, we also saw the continuation of things like the disruption in Suez Canal, but not increase in that. As we've heard, that's largely baked in now to the view. So our expectation for 2025 is that tanker market conditions relative to 2024 average levels will drop as a consequence of increasing deliveries, as well as, if you like, kind of normalizing demand growth, unless we see some other major disruptive event impacting the market. Conditions are likely to soften, and that's our view, not only into 25, but generally I think the tanker market has seen exceptional demand growth for several years, and we are thinking that oil demand itself is going to come under some pressure from China. We don't see those factors as ones that are going to go away. So structurally, oil demand growth is going to decelerate, and trade growth eventually will track that. It may be slightly higher, but it will track towards that. And I think perhaps one of the things that maybe is more under the radar in 2024 was the real weakening in the refining sector. And the tanker market really is a component of the refining sector. We really saw refining margins soften considerably across the course of 24, and I think that's playing into the weaker tanker sector. Also, we saw trade volumes flatten out in the second half of the year as well. So it feels like we've moved out of any kind of exceptional demand side growth. And meanwhile, we have this order book growing and deliveries, which again for tankers in 24 were very, very low. They're going to start increasing now. So it feels like the conditions are stacking up against the tanker sector, or at least the demand side has to do a lot in order to counter the supply side.
Yeah, it's quite a bit of a different picture from what we've seen over the last 2-3 years. I think it's very interesting what you said there about the impact that just like the shift to electric cars and so forth is happening in China, and the fact that it's actually enough to impact the market in terms of demand. Just coming back to sort of like you mentioned the sort of oil demand in 2025 and also the fleet growth. Can you put numbers to those?
Yeah, I mean, we're expecting the oil demand itself to be around 1%. I think the China, certainly in recent updates, we've revised down our expectations for China in terms of overall demand. As you mentioned, the electric vehicle side of things really is growing very fast. I mean, just to mention, through the course of 2024, we saw sales of electric vehicles outnumber conventional vehicles in China. So, that is happening now. The fleet side is picking up. It's still not going to be kind of unmanageable in 2025, despite the fact that we've seen very, very low scrapping levels. Deliveries are picking up, but we do expect fleet growth to outpace demand growth in 2025. We'll probably be looking at somewhere around 2 to 2.5% on fleet growth and 1.5 to 2% on demand growth, so not miles away, but starting to shift the market. But there certainly is potential for kind of more low case on the demand side. And I think we've seen OPEC Plus continue to push out their production cuts at the end of 2024. So there's a lot of concern around underlying oil demand in that regard. So, yeah, there's certainly some downside risks to things. And we mentioned as well that the Suez Canal situation could change at any point. And given that we've got the kind of maximum amount of disruption that's supporting the market, that change would be potentially negative for the market were that to normalise. So that remains a kind of uncertainty, but it's a kind of downside risk now.
So quite a bit of downside sort of factors there. Just looking at Trump coming in the US, he seems to be quite sort of pro, I guess, traditional energy versus alternative energy. Does that make a difference?
I think so, yeah. I mean, I think in terms of our outlook for North American oil demand, we have pushed that up somewhat. He is likely to remove the support for electric vehicle purchasing, for example. And I think there's a bit more uncertainty around, from the consumer perspective now in the US around electric vehicles and their benefits. It does add some potential upside to the oil demand picture as a consequence of that. But I think there are factors that may also go counter to some of the rhetoric perhaps that we've heard. Donald Trump in his election campaign was very pro oil production increases, and the phrase drill baby drill was quoted a number of times. But actually, when you listen to some of the producers, them in the US, or oil producers, are more concerned about the impact of, for example, tariffs that might have on their supply chain, being very cost conscious and shareholder orientated. Those are perhaps the more bigger factors in reality that could actually impinge on production. So that remains quite an uncertainty. I think from a trade perspective, we know that there is some trade, for example, between the US and China, US crude exports to China, not insignificant, but also probably not a game changer. More antagonistic geopolitical situation is likely with regards to Trump, with potentially with Iran and also with China. So those may factor into the tanker side as well in 2025.
So quite a complex set of factors to look at there, but overall, probably not as good a year as we had in 2024.
No, I think that's a reasonable summary.
Okay, great. Thank you, Tim. For the final section of this podcast, I'd like to look at something that's a major factor for all shipping markets, and we've been talking about, and that is the new building order book. And for the final section, I'd like to come back to Adam to talk about the shipbuilding market. Adam, there's been sort of no let up in new building orders over the last 12 months. So how has that sort of compared to previous, and which sectors have we seen most activity?
Yeah, and you say new building contracting in 2024 was exceptional. It's probably going to go down as the second highest ever year of contracting, with around 125 million gross tonnage ordered over the course of 12 months. That's only surpassed by 2007, where we saw around 170 million GT of vessels contracted. So a very strong year in 2024. It's higher than any other year we've seen in the last decade by around 25%, and is more than double the average contracting that we saw over the last 10 years. So it has been strong, and a lot of that strength has been generated by the container ship sector once more. As my colleague Dan has mentioned, 2024 is likely to be potentially the highest contracting total that we have seen ever, beating 2021. And we've also seen strong support from other sectors. The tanker sector, as Tim has already mentioned, we've seen around 60 million deadweight of tankers contracted in 2024. And that's amazing when you think in 2022, we only saw 10 million deadweight of tankers being ordered. So we've gone from 10 million in 22 up to 60 in 2024. We've also seen record ordering for LPG. 75% of all of those LPG orders have been focused in on the VLAC and the VLGC sectors. So I think there's been a lot of interest in the potential for new trades associated with ammonia that's helped drive that sector and that ordering. And LNG, although it hasn't been a record year for LNG, we've certainly seen another stream of orders come to fruition over the course of last year. And I mean, to me, it's very similar to that period in 2003 to 2007, where each year we seem to see record orders for one sector or another. And we seem to be in that sort of period at the minute over the course of the last 3 or 4 years, where consistently one sector is sort of topping out at all-time record contracting levels.
Some pretty staggering numbers in there, actually, and I noticed you used the word record quite a few times. I kind of hope that the fallout of this is not the same as what happened after that period in 2003 to 2007. Looking into 2025, are we set to see the same kind of level of activity on the ordering front?
No, I mean, to be fair, we have obviously been surprised by the amount of new orders that were placed in 2024. A lot of these vessels we had forecast to be contracted, but potentially over the course of the next 2 or 3 years. And I think what we've seen is some front loading of some of those orders. And as a consequence, we do expect to see order totals come off during the course of 2025 and 2026 for that matter. It's not that we're going to say that there's going to be no ordering this year in 2025, but as you rightly pointed out, I've mentioned the word record, and we have seen record ordering pretty much across the piece, apart from dry bulk. So we don't think that this can continue. We do need to see some more orders for, say, small container ships. We do think we're coming to the sort of back end of the ordering binge for the large container ships. And when it comes to dry bulk, if you look at the age profile of the fleet, there will need to be a almost wholesale replacement of the dry bulk fleet, potentially for the vessels that are over now sort of 19, 20 years old over the course of the next 5 years. We don't think that this ordering spike will come sort of later this decade when new building prices cool off a bit and lead times shorten.
Okay, so you are expecting to see things cool off a bit this year. One of the things I think that's been marked is the sort of over the last 2-3 years, I guess, is the real dominance we're now seeing of the Chinese yards. Where does this leave Japan and Korea?
Yeah, you're right. I mean, China in 2024 managed to secure around 2/3 of all orders when measured in gross tonnage. And that sort of pushed up the Chinese order book by 37 million gross ton to an impressive 151 million gross ton Chinese yards are currently sitting on. If you compare that to Korea, the Korean order book has fallen marginally over the course of the last 12 months. And the Japanese order book has fallen by around 4 million GT. So China is certainly winning the current battle to secure orders. Where that leaves Korea and Japan going forward is quite a difficult question to answer, in that the Chinese yards have managed to move very quickly and efficiently up the value added curve when it comes to shipbuilding, and also for the majority of the yards, the quality curve as well. The Korean yards and the Korean government are now investing quite heavily in new technology and productivity gains to try and keep ahead of the Chinese yards in the high value sectors, predominantly sort of the container sectors and the gas sector. It probably has to do a little bit more to try and wrestle back some of those container orders that have been lost to China over the course of the last few years. And I think that the hope for the Japanese yards is potentially that they concentrate and specialize on niche sizes, niche sectors, and potentially some of the new sectors that we see coming to the fore, so things like the CO2 carriers in the fullness of time, where they can sort of deploy some of their high-end technology on construction of some more of these more specialized niche new sectors than potentially the Chinese yards.
Okay, but overall, it does look like the Chinese have become much more dominant. And the other factor we're seeing from China is the yard expansion and reactivation combined. I think you did mention that the productivity increases, and that's opened up more sort of early delivery slots. Is there a risk of overcapacity down the line?
Yeah, I mean, we have been here before, and you're right. We've seen a lot of mothballed yards come back to life over the course of the last 3 years, and perhaps more worryingly from a long-term perspective, we've seen now some new yards starting to be constructed, some greenfield new yards starting to be constructed in China. But that's not to say we've also seen some yards sort of come back, being reactivated or reorientated towards merchant shipbuilding in Korea. And this is something that we've said all along over the course of the last 15 years, that once the shipbuilding market started tightening, once shipbuilding became profitable, some of those mothballed yards that were sitting would be reactivated and re-employed within the merchant shipbuilding sector. As you rightly point out, that does become a risk as we move forward. Obviously, it's great at the minute if you're an owner wanting to go and place an order, it means that you've got more variety, you've got more options to place orders, and there is a chance of getting your vessel quicker and potentially at a slightly lower price than if you were just relying on the shipyard capacity that was in existence, say 2-3 years ago. But what obviously happens is that, as we've said, contracting won't carry on at the same levels that we're currently witnessing across the next 5 years. We will see eventually a drop in contracting, And we then are in a situation where we've got more shipyards, more capacity now than we did have 3 years ago. So fundamentally, what happens if there's lower contracting is that yards start reducing prices, and we see a lot more competitive pricing by the shipyards in order to attract new orders, in order for those yards to remain fundamentally in existence. So what it will do is that as new building prices come down, it can lead to new building prices falling quicker and further than if we'd have seen that sort of capacity be maintained at the levels that we were sort of witnessing 3-4 years ago. So good for the short term if you're an owner, bad in the longer term for new building prices, which again may be a good thing if you're a ship owner looking to order in 3 or 4 years' time.
Okay. I think the quote of "we've been here before" could sort of like kind of sum up shipping markets as a whole somehow.
It's amazing how many people have short memories, though, Marcus.
Indeed. I think with that, I'd like to wrap up this episode. Thank you, Adam, and thank you, Daniel, Will, and Tim, for your valuable insights today. We'll be following all of these markets on seatrade-maritime.com throughout the year. And we look forward to returning to look at the markets with the team from MSI later in 2025 for a mid-year update. So thank you so much for listening.